After working on the main constraint of the bank today, which are liquidity one side and capital one side, we will deep a little bit more on the risk. The thing you have to have in mind that risk is something which is obviously necessary in a bank. If you have no risk, there is no result in a sense. It's not banks are not only a service company for which you deliver a service and then you have a fee, you have a remuneration of the service. It's what you have to have in mind is that at the heart of the banking activities, and that's why they are regulated, you have risk taking. If you don't take risk and you associate the savings of the household, of the individual, then obviously you are not a bank and you have not the same function and not the same needs to be regulated. So risk is a key thing, and you remember what we say yesterday, is that the total risk is viewed in the Basel mentality, in the Basel brain, I would say, as something which is finished, and then you have something which is a certain amount of risk which is taken by bank according to their asset mix, to their experience, to our knowledge, and the part is split between expected losses, so one we can reasonably expect to make a loan or to invest in such category of financial instruments, and the other one is the unexpected, we don't know, and you remember this is a key thing, capital is a thing which is in front of unexpected losses. And this view of capital to face unexpected losses is something we will come back in the coming session. So the coming session will be on the risk management issues, and the risk management issues are obviously very important. We say no risk, no gain. The original sentence is no pain, no gain, or no gain, no pain. But if you do not take risk in the banking sector, there is no remuneration. Obviously, you can have a lot of activities which are linked to financial services without risk. You can, without apparent risk, you can make payments, you can make delivery of say service which consists in custody, say taking care of your security, thing like that. But even that, it is with a risk associated. And even payment, you can have a problem in your computer system. So even a service company could have risk. But this is maybe a side, a very annoying, but a very side issue for a service company. When Facebook stopped to work during 6 hours in the US or worldwide, that's something very difficult for the company. And so you always have such thing. And the risk tool were a lot improved by the after the crisis, by the thinking on what is expected, what is unexpected risk. Often risk came out in areas which are supposedly not very risky. You see the huge losses at Societe Generale and UBS came from Delta One desk. Delta One desk are desks on which you have on the market activities. You put a lot of transaction in a desk, and you hedge the total risk of all the transaction against some risk. That's why it's Delta. It's one of the Greek letter to mention or to categorize some risk. You have obviously alpha, beta, gamma, etc. But the delta is one sort of risk, and you put a lot, millions of transactions, and both traders, the one from SocGen and the one from UBS, operate in an area which look a little bit without any risk, and it was a busy one, but a quiet one, and the risk came here. More recently, Credit Suisse suffered a loss of 5 billion USD in an era which is normally very safe. Maybe you heard about the Archegos crisis. Archegos was founded by a Chinese trader, Bill Wang, and he was quite aggressive and quite successful. But then in the early 2010, maybe in 2012, he was accused of insider trading in its hedge fund called Tiger Asia, and he was banned for trading for third party, at least in Hong Kong. And he moved to US and he developed a business of say family management of wealth, and it was his wealth and wealth of the family. He started with $500 million and reached something like $1 billion, but he managed that with a lot of leverage, and in fact he took a lot of position on the top of this 1 billion of equity. And normally the brokers like Goldman Sachs, Credit Suisse, Morgan Stanley, UBS, etc., JP Morgan, the investment bank more than the broker, they help the hedge fund or the family offices to do the trading. They give them cash in exchange of security. So you have a guarantee, you have a collateral, you receive share of a company, and you lend money in front of that, and you assess the riskiness and the value. And normally you mark that to the market every minute. And for any reason, the system of Credit Suisse were quite old, not the best one, and the guy was trying to split his bet between banks. Banks were not talking together. So in fact, when his hedge fund bankrupt, well, his family office in reality, he was obliged to liquidate all the position, and he had something like maybe 40-30 billion of assets, and the liquidation gave a total loss of 10 billion. So you see, and this is normally an activity with huge collateral. So it's normally an activity where you do not believe a risk will arise. It happened from time to time, but it was not supposed to be that sort of era, which could create a massive issue. And one of the issues was that the guy was managing a family office, not accepting funds from third party. So the obligation to publish information to make it available for the bank were much reduced than the obligation that an hedge fund has. So be careful, because risk could surge from a place where we do not when we are not prepared to see them. The normal way to face risk is to think about it and have a judgment on the possibilities that a client will not repay, or a possibility that a financial instrument value will deteriorate. Obviously, if the financial instrument is listed, you have immediately the change in value and you have the information. But for loans which are not on public market, which are private contract, you have some triggering events, and those triggering events are usually 90 days non-performing, 90 days where you do not pay your bill. If it's a bond, often it could be 30 days, as it is the case for Evergrande. Maybe if you read the financial press those days. So 90 days is the common denominator, but you have much more possibility to do that, to do a provision. For example, if you have a lot of loans on the one sector, imagine that you are making a lot of loans on the property developers in China, and you know that Evergrande and face difficulties and could bankrupt. Most probably, if the other has not bankrupt yet, you can question the value of your loan portfolio. You saw that Fantasia has faced the same sort of problem, not bankrupt yet, but still with the same sort of problem. And you have information about tens of property developer which could face issues. Obviously, China is China. You could have a support of the government, etc. But it's something which in which as bank you should start to provision. At the beginning of the COVID crisis, a lot of banks had hotel exposure, hotel hotel were without any client, so the cash flow were drying rapidly. So the capacity of the hotel to pay back the debt was more or less nil, and so a lot of the banks immediately, as soon as the COVID pandemic start to provision against the hotel. Obviously, the hotel has not defaulted when they were doing the provision, but they were more or less sure that some of them will have problems. Maybe the hotel owners are, say, rich enough to pour money onto the hotel, but maybe not. So this could be specific for a sector, an industry, or this could be specific to a country or to a group of companies. If you know that one company in one group experience difficulties, maybe it's because there are problems within the group and they cannot rescue one company. So you have many judgment issues or judgment qualities to put in, and that is something which is not totally say standardized. And this is something that the literature, the accounting literature, characterized as incurred losses. Incurred losses are IL, and they are losses on which you believe they are already in. You know them, you don't know them, but it will be quite sure that you will have problems. Then this system was working for century, but suddenly with the great financial crisis in 2007, 2008, most of the regulators, most of the supervisors said no. And the G20 in London in 2008 asked officially the standard setters, the accounting standard setter, both ISB International and FASB in the US, to change the system and to think about a new system. And then this new system was presented a couple of years ago, and but it took also some years. So it took roughly 10 years to be fine-tuned, and the name is IFRS 9 for international accounting and CECL for US. And the way you recognize the losses will seem familiar to you, because the way it will be implemented will be based not on the past event, but on expected losses. You remember what we said on the capital building, the capital requirement for banks. The thing is consistent with the capital, with the Basel Capital Agreement. So IFRS and the US GAAP change their mind and say, okay, we should have banks producing provision ahead of the problem, because when the problem started, if you don't move ahead, then you will not have enough provision. The motto of many politicians, many regulators was that the provision in banking sector were too little and too late. And this too little and too late motto was really something important. And the U.S. Senate put a report like that. The one of the UK Parliamentary Commission was also following this sentence, and they say we do not want to do that again in the same position. We want to be prepared. We want banks to have enough provision. You remember on capital we say the same. The bank capital was increased by 2.5 times, or at least 2 times, from the old tier 1 of 4% onto the CET1 of 7.5. So it is a big change, and this is something which is very important in the banking sector. And not all the banks were able to do that softly. That's why also the delay was very important, because to give banks a lot of time in order to do that. It's still very subjective, but because you have to make an assessment, a judgment on where is your losses. But the one very positive thing is that banks will has now to give a lot of information on the asset quality. The big but is that it is something which is good for the disclosure, but it's far from perfect. Then if we look from on the past data, this is an old IMF chart. IMF was each year, or maybe twice a year, they put a report on the financial risk, financial situation. And the reports are often of good quality, and there are a lot of data included in. And here you see, thanks to the US and the statistical richness of the US database, we can see that apart from the 29 crises here, on the top here, we just have very few. So here, the cumulative losses, the charge-off is the US world to say losses. It was at a peak of 5%, and they estimate at that time that the great financial crisis would be along maybe 4%. In fact, it was slightly above that, so close to 5. So it means that we had two experiences of very severe crisis. But apart from that, the average, if you draw a line, sorry for my bad drawing, but if you draw a line, you are around 1%. So it means that the risk, the average is one thing. But if you want to be prepared to the average, that's the expected losses. That's where you should have your margin, your collateral, your fees, your other revenues. If you want to prepare for the big rise in risk, here you have emerging market crisis. So you have a property crisis in Europe. So it's still with some mini crisis close to 2%. So then the question is where you want the dam to be. So the system they were working on was built on the, say, 3 blocks in IFRS. And the 3 blocks were the following. The 3 blocks is to say you have 3 categories of loan. You have the category 3. The category 3 is the loan which are already non-performing, and you believe you provision them, and you believe they are doubtful, and so for those loans, you provision 100% of the losses you estimate, but that's only of the losses of you estimate. You do not provision 100% of the exposure. If you have a loan of 100, you remember our probability of default and loss given default. We will put there a probability of default of 100 because we believe the client will default, but then we will recover part of our loan because we have collaterals, we have guarantees, and maybe our loss given defaults, the losses we will have experiences within the experience of a default will be maybe say 40%. I have 100, I will lose 40, so I will recover 60. So my need to provision is 40. But obviously you have to put that with a time value, because if you recover 60 in 4 years, that's not the same that recovering 60 now. So there are some subtleties, etc., but that's fine. Here you have the stage one. Stage one are loan without any problems. Quality is still good. Since your originate a loan or purchase a loan and put them on your balance sheet or the financial instrument, the situation has not changed. So the requirement is to provision the next 12-month losses, and you estimate the losses of the 12 months, so 1 year losses on a loan. So if it's a loan of 1 year, obviously you estimate the losses of the loan on its full life. If it's a loan of, say, 15 years, a mortgage, you will split the 15-year losses, expected losses, onto the 15 years and take one of that for the next 12 months. So it means that it's a small amount of money normally now. And if it's a loan which is not defaulted, you do not believe it's defaulted like stage 3, you do not believe that the loan has no change, but you believe that the loan had experienced significant change in credit rating, in credit assessment. So then the big question is, what is a significant? And so there is a lot of debate on what is significant change. A significant change should be a deterioration of the credit rating by, say, 3 notches. That's usually a good definition. You made a loan, you believe that the rating was, say, A, and your rating now is down to not to A minus, not to triple B plus, but to triple B. This is a sharp deterioration of your rating assessment. It could be the one of the rating agency, but it could be the one of your internal model. So if you have such deterioration, you do not believe that the client will default, but you believe that the client is facing a lot of pressure due to the cycle, due to idiosyncratic issues of the client. So it's a good thing, but you see, significant is a judgment. So in the text of the standard, there is nothing like such a definition saying 3 notch. That's something which is a practical interpretation made by auditors, made to some extent by regulators, but the banks are normally free to assess what is significant. And so you see, one bank could believe that this is a significant decrease, and another bank will say, no, this is not a significant decrease. And some bank could say, maybe I was on the A, now I'm on the triple B plus. That's a significant thing. Obviously, if you are on good quality loans or financial instrument, bonds, that's okay. But if you are on the low quality ratings, say if you are on B plus, if you move from B plus to B minus, that's maybe enough to be significant, because you are moving closer to the default category. So you remember our table of yesterday with the capital computation. We have Basel I matrix at the top, Basel II standard in the middle, and we have Basel II internal at the bottom. And in the Basel II internal, we have a rating system, and this rating system is moving along with the probability of default and the fact that the client of the bank could default. And if you are moving closely to the left part of the chart, you maybe even one notch could be very difficult. So this system is working for IFRS, and in the US they choose a system close to that, but they say no, we do not want to have such a system. We just want to have a system which is stage 3 only. We do not want to make a differentiation between stage 1, stage 2, stage 3. There is too much judgment incorporated in. We just want to have an estimation of the expected losses over the life of the instrument, and that's okay. One factor explaining that is that in the US, the bank have a shorter maturity loan book. It's often 2-3 years, whereas in outside, say Europe, outside US, it would be closer to 5 years. And then a lot of the loans of the bonds of the US bank transit with the market. So a lot of them are in fact moving with the market. And because if you want to move with the market, you need to have something which is at fair value very quickly. You remember what we say, US is a market economy. 80% of financial instruments, 80% of the financial instruments are located in markets, and only 20% are located in banks. And so that's the explanation of the divergence. So you don't have the same system between US GAAP and IFRS, but the philosophy of the system is the same, to build provision ahead of the crisis. So that's explain the part of the issue. I will try. Normally, it's a YouTube. It's a YouTube video I want to show you. So we should be able to see that in our system, because as we experienced yesterday, it was not supported if it was not video. So where it is? So please bear with me 1 second. I don't know why it's so slow today. It was working fine the day before. Okay, here we are. Copy. Now it should work.
The top line is up, revenues are up 4%. And if we look at our main activities, retail activities, they kept up well, despite the major impact of the lockdown on clients on point of sales. And if you look at particularly in June, you see the recovery taking hold.
Something I do not mention is that it's a video commenting the result of last year, so H1 2020. So just 1 quarter after the starting of the pandemic in Europe.
A recovery, like for example, the credit card levels back to the pre-COVID level, and so is loan demand. And then, given that we are diversified, there is CIB, and CIB is a platform that we have honed over the last couple of years and that has seen exceptional level of activities building on this strong platform. And so this basically building also on the continuous client presence and helping them in their role of raising capital for corporates, for sovereigns, and basically distributing that to investors. So that's the activities. And this BNP Paribas, we have been able to do so on the back of our financial stability. Basically, if you look at the common equity tier 1, it's further up, 12.4%, and the available liquidity reserve is over 400 billion euros. So in this context, the net income of 2.3 billion is a witness of solid results, and the ROTE of 8.7% is a tribute to that.
Now let me ask you about provisions, because that's something that, of course, the market is very much looking at the moment. So you announced 329 million provisions for the second quarter. That's on top of the 500 million that you announced in the first quarter. So let me ask you, do you see further provisions for the rest of the year, or did you front load the further provisions in the first half?
Yeah, if you look at the IFRS rules, they basically oblige you to have a forward-looking view and reflect the cost of risk in this forward-looking stance. And so in the first quarter, we took a forward-looking view on the impact of the pandemic. And we basically...
Okay, let me check if I can have it without echo. Okay, tick. Tram, do you know how to solve that? Sorry to bother you.
Sorry, say something?
Yeah, because there is a huge echo on the video.
Actually,
Is that?
I cannot do anything with the echo of the YouTube link. I suggest that.
Or maybe I can put, if I put my computer on mute, I will try. Maybe that's something you can listen to. Just tell me if I put my computer on mute. Send me a message saying if there is echo or not.
Okay.
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 It's better.
Oh, okay. So I will start again. Sorry for the misfit, and I put my computer on mute. Okay, so I hope the quality was much better. I wanted to show you that video not because it's very specific, but because of two things. You maybe notice
BNP Paribas.
you notice maybe the blue box, which is below the picture of Lars Marchenil, the CFO of BNP Paribas. The liquidity reserve is over 400 billion euro, and this message was the message that the lady from CNBC put as he was not commenting that much. That it was a key thing, but that was a thing that the lady believed was a reassuring thing. But he's talking more about result, activity, provision, diversification, businesses. And the other one I wanted to show you, it's only because it's an amazing one. Here they put BNP Paribas CFO provision an extra 300 billion. It's wrong. It's not 300 billion. It's 300 million. You saw Lars Marchenil mentioned that the results for the quarter was 2 point something billion, and they cannot, a bank like BNP cannot provision, and any bank in the world cannot provision 300 billion. So it was amazing to see that the message at that time was that because market was under pressure, was that the messages wanted to be reassuring in a certain sense, but it was fascinating to see that professional like CNBC journalists were maybe doing the thing too quickly and were not checking the information. 300 billion, it's something impossible. So that's the thing. And but you see, Lars mentioned the horizon, the foreseeable future, and the fact that the environment was deteriorating because the lockdown were extended, obliged them to think about a more difficult scenario. In the US, they were doing more or less the same thing, but with much bigger amounts, in a sense, because they provision all the loan book for all their life, and that means that in the US they provision a lot in the first 2 quarters of 2020, more or less nothing in the rest of the year, and they start to write back the provision to put them back in the result. In Europe, the behavior, the pattern was quite different because the bank continues to inch up a little bit the provision till the end of 2020, and start to more or less stop to provision or to write back some of the provision in 2021. But the level are very different. So back on our system, I wanted to show you the this is HSBC explanation on how they moved from the old system of IL. So you can, if you are accounting fan, you can recognize that they say it was IAS 37, IAS 39, and they moved to IFRS 9 ECL, expected credit losses. And then on the old system, you have individual provision, and what we say about, say, collective, the exposure to Chinese property developers, the exposure to hotels, etc., etc. And they had IAS 37 is a category of generic provision. But then they took that amount and they say they put on the top of that the ECL for the 12 months and the ECL something we discussed about the lifetime. So lifetime is stage 2 and stage 3. And then one thing we didn't mention, but Lars Marchenil, the CFO of BNP Paribas, mentioned it a little bit, is that the horizon it has to be with the incorporation. The provision has to incorporate a scenario, a view on what you expect for the future, and then it means that this thing obliges the bank to have a macroeconomic scenario. There is no obligation to have 1, 2, 3, 4, 5, but there is a recommendation to have 3 scenarios: a base one, a good one, and a bad one. So then, and you put some probability on that. Often when you start, you put 50 on the base, 25, 25. But then if you are in the middle of a crisis, obviously the weighting of the worst one will be much higher. And here you have, due to the fact that they are taking into consideration, say, some weight on the bad scenario, they add provision. At the end of the day, you see most of the provision are on stage 3, which correspond to certain extent to the individual provision made on loan. Because on stage 3, you believe that you put the desperate case, the bad names, and that more is the same than individual. But that's not always. And then stage 2 and stage 1 are supposed to be provision which are not totally required by the existing situation of your client, and that's where the expected losses change state for most of it. And you have a small amount of provision for the loan you purchase, and so that's you purchase loan and you have a deterioration. That's a small category normally for banks. And so here you have a discussion or presentation by ING on how they move from the different stage 1, stage 2, stage 3. But I believe I have another video, and now I will try to be a little bit better at video management, and that should be, I hope it will work. If not, I will comment it. Copy. Back to black button. No, this is not something, okay, because it's a proprietary one. So sorry for that, it's not something. So what you see here is that they have an increase, a huge increase on the, so that's the very beginning of the crisis, you see. So Q1, they close the account in Europe without any problem in stage 1. Obviously, stage 2 and stage 3 start to move a little bit, and they split that between wholesale and retail banking. But the bulk of the change came in Q2, and in Q2 you can see that there is a big thing in the losses within wholesale, and that's stage 1, and they had a sharp increase, but that's also the case in stage 2, to some extent in wholesale, not that much in retail. No. Okay, and sorry, I didn't saw your hand. So this slide, yeah, okay, sorry. I will put on Canvas. You believe it's not in Canvas? Okay, I will have a look. Should be, but okay. Let me check. Yeah, because it's, I suppose it's more comfortable to see the slide directly in the package. I thought I put them this morning, but because I experienced couple of difficulties. Maybe it's not. Maybe I failed to upload the presentation. So let's see, file. No, you're right. Yeah, there is nothing like that. So I will just put it now. Thanks to ask me to upload again. I hope it will work this time. I'm just doing it now. It's more or less done. Maybe 1 second. Okay, should be okay. Okay. Can you tell me if you can see it? Yeah, because those okay. sorry for the inconvenience, because I suppose it's much better to have it on a proper screen. And so this sort of detail is quite important because it can help you to understand the asset quality of a company, of a bank. And this information is, however, very difficult to compare. So it's nice for the regulators because they can group and ask and engage in a conversation with the company, but it's much more difficult for the investors to move with that. The other thing I wanted to mention, so I hope it will work if the ING CEO. Okay, let's see if it is working. Oh no, it was the one which was not working. Sorry, so that's my mistake. So this is the one which is not working. So then the one thing I want just to stress, but it's not a big point to enter in the detail, is that it's IFRS 9 disclosure is very nice, but it's very annoying because it's not totally plug and play with Basel III. In Basel III, you remember, we have a standard method and we have an internal method. And we didn't discuss that much, but there is an option which is very much used for every bank to use standard and to use internal for different portfolio. And for using internal, and that's maybe something I didn't mention, you need to have the authorization, the stamp of the your regulator. So if your regulator in Europe is ECB, which is the case for ING or BNP Paribas, then you need to have the stamp of the ECB in order to apply the internal method to that category. Say, for example, to mortgage portfolio in France. But if you want to do that for mortgage portfolio in Germany, and ING has a German mortgage portfolio, then you have to redo the exercise and to say, look, my model for Netherlands and Belgium are good, but also they are good in Germany. And the ECB as a regulator should give you a stamp also for Germany. If they say no, it's no. And then it's moving to standard model. And the issue of that is that you have today in the portfolio some portfolio in standard model and some portfolio in internal. And there is a bias in that, which is that the portfolio with the higher dispersion, with the most important number of loans, of items, with a lower probability of default tends to be easy to put on internal model because you have a lot of data, you have a granularity, you have many data, many numbers, so you can play with it and show on long term. So you can say for BNP Paribas, for example, they have not millions of clients in consumer lending in France, but they may have 2 million clients in consumer lending. 2 million clients, you have a good database. Obviously, this 2 million clients is moving. It's not the same today than it was 5 years ago. So, but it's still a good base. You can produce data, you can show some stable trend, you can show average, you can show volatility, and you can persuade your regulators, and you should be doing that on something which is which is inside an internal model. And often internal model for good portfolio have a lower weighting. You saw that on maybe on the matrix page. So Basel 1, Basel 2 standard in the middle, and Basel 2 internal model at the bottom. The better the quality, the lower were the probability of default, the loss given default, etc. And the K coefficient. We do not discuss the K coefficient at this stage. We will discuss it before our exercise on Sunday morning, before you finish the exercise. The thing is that this is something annoying because you see Basel 2 standard is not working with expected losses. It's working with external rating or a rating provided by a rating agency. And the business of the rating agency is to forecast the probability of default. But then they do not give directly the probability of default to you. There is a link, obviously, but they give you an A, a B rating, etc. So it's not the same. So the part which is in standard in Basel 3 is not working nicely with IFRS 9. And that is creating some issues. You have a couple of the issues which are listed, and that's the bread and butter of accountants and people working in risk system, in consulting. So there is a lot of job created in that area to make Basel 3 and IFRS 9 fitting together. Then the thing I wanted to play with you was to play on expected losses, and I wanted to show you, but I believe I need to show you another document because this one is a framework. But basically the idea is to say expected losses has a huge impact on your profitability. Imagine a loan of $100,000. You have an interest of 1%, so maybe a mortgage or something like that. You have a cost in to manage it, so your interest is a net, that's your spread. You have a cost of 0.35, and we test different expected losses possibility options. You have 0.05%, which is very low, 0.25, 0.50, and then we try a CECL like the American way, which is say 25 basis point, 0.25%. If we do that, in order to compute what is the P&L of that client engagement, we can. So I will try to take a one which is in better shape in order to work with you the exercise. So please bear with me 1 second. Okay, that's the one. I should put that one on the. So I should upload that one. So it is working. I hope it will work. So we'll try to close the video and to put it on full screen. So we'll close the video just one in order to have the table. Can I enlarge the table? Yeah, but then it disappears. No. Ah, yeah. Okay. So then I suppose I can move up. Maybe not. Oh. No, I cannot. So it's a disaster. Sorry for my bad movement. No. Okay, I will try it again because it seems it's not working that way. So I will try it again. Where is the exercise? Well, I will stop to share and do another one. So I need to go back to the presentation. Okay, so now I'm back on the presentation. I will try again the exercise. And I hope you will be able to see the file, because I cannot see. Maybe if I share. So, no, I cannot see the exercise, which is very strange. I don't know why. So I try again. No, it seems that nothing is working. Okay, so I will work with you in the on that and give you the solution on time. But I don't know why. Let me try another thing. Maybe working. No, it seems not to work. My systems are not working nicely today. I got a couple of issues. Sorry, I got even problems to be back on the session. Okay. So sorry, because it seemed that the idea to put an Excel file in Direct is not very good, but now I have no more any presentation. So we'll try. Okay, that's the exercise. So I'm sorry, but here you will see that you have the table. I will comment the table and then make the essential of the table, and that's why EL is an important topic. You see here we have a product. If we have no risk, we have a loan which is with a low weighting, 25%. So we know the equity. The equity is a certain amount of risk-weighted asset time the risk-weighted asset being a certain amount of the loan. So here we know we have a very small amount of equity, 3,750 for a loan of 100,000. So it's a small amount, but even with this small amount of equity, we need to have a certain level, a certain return on the equity in order to accept the loan. So if we assume that the expected loss is very small, and with a cost which is limited, we expect a cost here to be 35% of the revenues, which is the cost ratio. Then we will have 350 here, and then we will have pre-provision profit 650. Then expected losses will be 0.05 of the loan, which is 50. And 50, you see, it's a very small amount. So it means that the post-provision profit, the operating profit, will be 600. And so if we assume that the tax rate, and we do not have anything for tax rate, but I wanted to do it with you. So the tax rate we assume could be, say, 40%. So we have 600, 40% of 600 would be no, I put the tax rate, I guess. Let me check. Yeah, I put the tax rate at 30. So 30% tax rate. So 600 times 30 is 180. So it means that the net profit we have on that is 420. So if we have 420 here, that's our net profit. I will try to write not too badly. So if we have 420 on 11, on that amount, that's around 11% of return on equity. So it's okay in most of the criteria. Cost of equity could be in that range, but it means that moving to higher losses, 25, 50, and full life, here you will have a lower profit, and the computation is here. You just make a 3% return. So if you do a 3% return, the decision you will take is not to do the loan. So what you have to have in mind is that if you incorporate the expected losses toolbox in the bank brain, then obviously it will have to be linked to the decision mechanism for the credit. Because if you do not embed that in the credit department, and if it's not moving down to the credit officer, then obviously it's something which is a waste of time. Then the credit officer had that information. However, even if you have a 3% return on that loan, maybe this client had other operations, had other products, had many things. So you can agree to have this thing yielding a 3% return, not an 11, because you believe that this is the riskiness of the client. But you say, okay, at the end of the day, or the client has today a lot of relation with me, or in the future, he will have a lot of relationship. And here, if you take the CSEL of the US, here, obviously, you have a negative result. You have a negative result because you take the losses for the length of the loan. So here it's negative because the expected losses, you accumulate the expected losses for 10 years, 5 years. So it means it's much more difficult to take a decision on the quality of a product made on the US one. The CSEL is very nice because it's increased the provision level, but it's not something you can directly implement it within the credit department. You have, in fact, to go back to the IFRS 9 expected losses information, or you have to split it on a 1 year on the next 12 months. So you have to make an additional computation on the CSEL to compute the lifetime of the losses. To say it's negative, it's producing a huge losses. And if I remember correctly, if I take a loan for 5 years. For 5 years, my result was very, very negative, and I was with something which was minus here 15%. So minus 15%, it's not something you want to show. And this thing, this minus 15%, this negative result has a name in accounting, which is a day one loss. This day one loss is a fact that accountingly you are obliged to account, to register a loss because you are doing an operation. It looks a little bit stupid. Maybe the client is okay. Maybe the yield is not fantastic. That's our mid case, 0.25% loss, 25 basis points. But in the US system, this is producing a loss because you account, you front load, you take as a front operation all the losses which will come in the future in the life of the loan. And you see, the loan, even not being very risky, is very long. Then obviously you will take a huge reserve against this loan, the possible losses. And the name of the law of the reserve, could be allowances, could be provision, but they are the same. They are to say you need to create a buffer in order to face the future losses. So this is something which is a little bit easier in organization to split between the expected losses coming from the IFRS 9, and I will try to pass you another video. I hope the video is working, and I suppose because it's a YouTube, I guess I was trying to check that the YouTube were working, and I will do the same and cut my mic.
You are now unmuted.
So it's without any publicity for the accounting guys doing the job. But you see, one of the important thing here is to say we have a big change, and I choose a Canadian company accountant department because the Canada was using US GAAP until recently, and they moved, I believe, in 2017 to IFRS, which was a big move because Canada is very close from US. A lot of the Canadian companies are listed in New York, so and a lot of Canadian companies have operation in the US. So it was a big decision to move to IFRS, and then at that time it meant that they were moving from the possibility to have a CECL system, and then they were moving to an IFRS 9 system. And it was quite a big change for them. And he focused on one point, which is be careful. You maybe data, just data supplier is something which could be very difficult in the existing system. So there is a huge work to be done, and you see the accounting guys and the consulting part of the accounting companies are very happy to develop that because it's a huge job. So at least regulation was created jobs in risk, in monitoring the risk, in compliance, because you need to have that. Another area which encompassed a lot of changes was the one in charge of the standard model, and their job is to do that. It's the rating agencies. The rating agency were very much criticized in the crisis, but because they were very bad at assessing the riskiness of the complex products, they failed on that. That's very clear. They were rating state debt, corporate debt, and complex product debt, and bank debt. So four categories. On three categories, sovereign, corporate, and bank, often they were okay. You have some example before couple of days before Enron bankruptcy, the Enron rating was still in the A range, and Lehman Brothers was also in the A range. But because implicitly it was assumed that the Federal Reserve will not let Lehman bankrupt. Okay, that was a wrong assumption, but you have some cases. But on complex product, those securitized product, it's a small poll, but you know, on complex product, what is the percentage which turn to be junk? So I will put a couple of answers. And we will start soon the poll. Okay, then the question is on complex products. What was the which were labeled as good quality? What is the percentage which turned to be junk? So on complex product, rating agencies say, okay, it's a very good one. It's my best quality. It's an A, AA, AAA. So often it was A, AA, AAA. So I put my stamp, I put a rating, and I say, this is something which is a very good quality, just on complex product like securitization product. So and then so that was before the rating was before the crisis, and the outcome was 2010, I guess. That was a report from the US Senate or 2010 or 2011, so maybe 2-3 years after. But only on the one which were labeled good. But often the rating agency job were there because the issuer wanted the rating agencies to say that's okay or not okay, and then to have a rating. And they discuss the rating a little bit ahead of the disclosure in order to say, okay, what should I do if I want to have a good rating, etc. So that was complex product with an excellent rating. So imagine you go to your fish shop and you ask the vendor, please give me the good fish you have, what you advise, and you say, okay, this one is very good. And 2 days later, you are totally sick, and that was a fish. So I believe you have no trust anymore on the vendor, on the shop. So that's very important that the quality is, should be assured. Any more answer? Okay, if there is no more answer, I will close the poll. Okay, then that's the result. Most of you say 20, some close, well, it was close to 50%, to the answer 50%. In fact, the real answer is 80. So it means that, say, 4 on 5 of those products, which were labeled as excellent, very good fish of the day, perfect, very good, I can assure you, trust me, etc. So you purchase it first thing and without any trouble. And then 2 days later, here, 3-4 years later, you look back at the product and the products were totally rotten. So what is the trust you have? Then the rating agencies claim, okay, it's not that the First Amendment or second, I guess it's the First Amendment of the US Constitution, it's the freedom of opinion. So they say, no, it's just an opinion. We do not force you to purchase a product. We just give an opinion. And because it's an opinion, it's free. And then you cannot sue us. So that's also the reason why there was very few problem with very few litigation for rating agencies. But what we still have to have in mind is that for the rest of the job, for the corporate, for the banks, for the sovereign, it was working pretty well. Obviously, this is an oligopolistic market. The three of them, Standard & Poor's, Moody's, and Fitch, perform very badly on the complex product, but perform very well on the rest. So the issue was complex product. So the first reaction of the regulator was to say, but just prohibited complex product, or make a different rating system for complex product, and put a flag saying a red flag or yellow flag saying, okay, it is a complex product, and you give an A, but that's an A rating for complex product. That's not an A rating for a normal product. But then it was viewed as a little bit annoying. So there was a lot of incentives to develop new products, better products, but nothing like that happened. In 2010, both US and Europe say, okay, we should forget the standard method based on rating agency. But at the end of the day, they are like thermometers. They give the temperature. Obviously, you need to be sure that the reading is good. But if you have the temperature, maybe one agency could be enough. Okay, 3 agencies is an oligopoly. It's not far from one. There was also a temptation to put the IMF at the World Global Rating Agency, but it was not working. So the system is still working with the 3. They have 94, 95% of the market. they have slightly different methodology. So three is useful, and for our standard method, often we need to have two opinions of the accepted rating agency. So it means that the rating agency has to be registered by regulators, by banking regulators. So it means that in Europe, ECB has to say, okay, I agree Standard & Poor's, Moody's, Fitch, Dominion, DBRS, and other rating agencies, maybe Scope or whatever. In the US, the Federal Reserve and the SEC are doing the same for their US rating agency. So here we will see the rating matrix, which is a very classical one. You see that normally if you give a AAA rating on 10 years, you should have 0, 0, 0 default. So it should be pure quality. It should be perfect. But obviously that was not the case in complex product. And if you put a AA, it means that the losses should be very, very little. And the issue behind that is that in 10 years, obviously your AA company could change, but it's a very strong company, a very strong issuer, a very strong entity, and they can survive very nicely to most of the external events. And you see, however, if you move to B, which be a B category or double B, maybe double B could be typically the rating of a cement company, which is with a lot of fixed asset in a downturn. I remember the Holcim, which is one of the leading cement company, enjoy a triple B on a normal market condition, but then it moved to double B on a more difficult market condition. A cement company like Cemex, which has more debt, was even going to the B category on difficulties. But that means that it's along the cycle. It could move up and down. But you see a double B category, you still have a lot of risk inside. And that's maybe something which is a good separation in terms of high risk and low risk. And often the border is a triple B plus. If you are triple B, if you are above triple B, you are investment grade. Below triple B, you are non-investment grade. So it means that it's a separation, but at the same time, it means that the categories of investment grade and non-investment grade define the possibility of some funds in the US, mutual fund, to invest or not in the paper. If for most of the mutual fund, they can invest only maybe 20-25% of their investment capacity on non-investment grade, on the very risky one. It could be attractive in terms of yield, but at the same time, it could be very risky. So, and you see that the thing you have with the AAA, the scale at the bottom of the page, it's something which is very close to the scale we had at the bottom of the matrix page of the exercise. Maybe, well, before moving to securitization and risk transfer, we will make a break because that's a different chunk. And so maybe I will give you another 15 minutes like yesterday, and we will start at 20:45 in 15 minutes. So enjoy the break and see you soon. Thank you for mentioning.
Thanks a lot.
So the other, so you have the Fed supporting the bank, but you have also the Warren Buffett. So Warren Buffett is one of the richest men in the US. So he invested through Berkshire Hathaway in banks in order to give them some capital, or to support them with capital, to supply them with capital, or to capital or something close to capital, which is not CET1, not pure capital, but AT1, additional tier 1. So the part which is the difference between CET1 and the tier 1. But in some cases, he invested also in pure stocks when he thought that the company was close to recover or would have a potential. So in that case, the Fed stress test purpose was just to check. It was a medical check, in a sense. You need capital or not. It was very practical, very empirical. Then the Fed stress test moved since 2009 to something which was mostly a search for outliers. Outliers were mostly foreign banks, and on the past 10 years, foreign banks with issues used to be HSBC, Deutsche Bank, and the Fed tried to intervene in the management to ask to improve the risk system, etc., etc. And more recently, since 2018, the Fed say, okay, you are more or less in good shape. You want to distribute a lot of dividends. So we will use the stress test in order to control how much dividend you can pay to your shareholders. Or in the US, they do a lot of buyback. So the bank purchase its own share on the market. You have to make a notice at the market authority, and then you do that. And so it's moved from a medical test to something which was a spending test, how much money you can give back to your shareholders. And today it's really that. It's really checking this thing. And in order to determine the level they can pass back to shareholders, they create a capital conservation buffer on the US way. You remember maybe yesterday we mentioned that we had a CET1 minimum of 4.5, and then we have a capital conservation buffer of 2.5, which means that we have a CET1 minimum requirement of 7. And this 2.5 of capital conservation buffer, which is important if you want to distribute dividends, is fixed at 2.5 in the BIS regulation. In the US, they say, no, we will not do that. We will do a minimum of 2.5 or the result of the stress test. If you have a CET1 at the beginning of the test of 13.13, and if at the end of the test your CET1 is 9, this is a decrease of 4. And because this is a decrease of 4, we will take this 4 as your capital conservation buffer. So it means that rather than having 4.5 plus 2.5 equals 7, they will have 4.5 plus 4 equals 8.5. So you see, and it's a big it's a big it's a nice tool for the Fed because it's linked really the stress test to outcome to the bank capital management, and it is something which is quite important because the investment bank like Goldman Sachs or Morgan Stanley have requirement of capital conservation buffer which are close to 6%. So it means that the CET1 decreased by 6% during the stress test. So meaning that their minimum requirement should be the minimum CET1 for 5 plus 6%, so i.e. 10.5. So even if they have apparently excess capital, they cannot be below this level of 10.5. So this capital conservation buffer is the key thing which limits the dividend. Because if the company, the bank, which are volatile and very sensitive to the stress, distribute the money today, they will have no money when the crisis comes. So the idea is to be prepared to the crisis. It's the same philosophy than for provision. You should build your reserve before the crisis. It's a very old-fashioned idea. It's the idea that you have sunny days, but you have also rainy days. So when it's good time to make reserve. It's something that a farmer will understand very naturally. So any simple thinking about life should say back this sort of philosophy. But this philosophy is not exactly aligned with the market value idea, because the accounting system is very much based on accounting value linked to fair value, meaning that you just take into account the latest information provided by the market, believing that the market will be right. But we all know that before the crisis of 2008, 2007, market was high, and then the decrease was roughly 30%. So market give a lot of very useful information, but market could be blind. So the trust in purely market fair value is okay and should be used as a tool to drive the bank, but at the same time, you should have buffers, you should have things which could be regulated by the regulators, because they are more systemic. So market information is very good at micro level, but the regulators at macro level need to have more information based requirements, and so they have more macro prudential tool. So bank management has to take into consideration both this micro thing and largely based on market views, and those macro things which are more the regulators' way. So putting the two together is sometimes a difficult thing. So here you have the outcome of the latest stress test in the US. You see that, okay, that reflects the US loan book. You see on the right side, you have the losses, the breakdown of the losses. You can see that the credit cards, which is quite important in the US, is making a lot of the losses, but that the commercial and industrial loan too, and the other consumers. And on the left side of the chart, you have the same in $1 billion, but you have also the ratio as a percentage of the loan book. So you see for credit card, the loss rate, which is assumed for the 9 quarters, is 16.2. So that means that they suppose that the loss, the expected loss on this portfolio is 16%. So it means that 16%, that's a lot. Maybe the loss given default is close to 100% for credit card category, but it's a lot. So then, but that reflects the US economy, and we have also to be quite modest. I put you a good book that is available in Vietnamese, which is the book on the black swan, and the author is a very nice one. Is very provocative. Nicolas Nassim Taleb is very provocative academic. He make a fortune being a hedge fund manager. Then he make, I believe, above $100 million of personal gain. So nice. Now he's not working anymore. He's doing lecture on risk, and he's writing poetry, I believe. But he's teaching at in New York, and visiting teacher of many universities. But he's doing what he wants. But he's still focusing on the risk. On the risk era, and this book tries to explain that we are very bad prepared in front of risk. And then unexpected items are really difficult to think. And the book is it's a good summer reading. So I don't know, maybe it's not good for the TET because you will have a lot of family obligation. But if you have some free time at some point, it's a conversation with a lot of examples. So it's not a dry. He wrote other books which are very dry, but this one on the black swan is very nice, and it's recommended reading for anybody working in the bank field or financial institution field. And in terms of personal development, it's also very good. The basic of the book was, in fact, on his experience, how bad we are to be prepared to unexpected risk, and how comfortable we want to be in front of risk. We have the many reassuring messages we massage ourselves with, and it's a fascinating book. The one thing which he explained, in fact, is that the Basel Committee work is nice. You remember we split the risk between EL and UL. So EL and UL, that's okay, that's fine. But EL is the risk we know, so we know what we know. UL is a risk we don't know. So we know what we don't know. But outside of that, there is something which is we don't know what we don't know. So we know what we know what we don't know up to a certain amount, and we don't know what we don't know. So the model could be wrong. So there is a consensus in Basel to produce this model, and it's the best estimates. But outside of the box, there is still something to be an unexpected outside of the box. So we still have to be very pragmatic, saying that the best outcome we can provide. And obviously, Taleb mocked a lot the very serious people from Basel if they want to be too sure that the system will weather any crisis, any sort of crisis. But there is a limitation in the modeling, and that's something very important. We always have to have in mind. We can model the thing, but if we are bad if our model are bad, even if we have good ingredients, obviously the outcome will be bad. And obviously, if the model is good but the ingredients are bad, obviously the outcome will be bad. But this is a very nice. This is a very nice thing. And then he mentioned also, but that's a side thing, that the long-term risk is something very difficult to take into account. Maybe you heard about Mark Carney. At that time, he was governor of Bank of England. He was a former governor of Bank of Canada. And now he's a special UN ambassador to financial reform or something like that. And he made a speech about the tragedy of the horizon. And this is something to say we are unable to think away from our comfortable vision, to take into consideration disaster. And he wrote that specifically for climate. And for climate, he say we cannot do that naturally. So we had to make a collective effort in order to insert that. So there are a couple of people and a lot of NGO working on that. And you have a lot of things also on the non-financial risk. Most of the long-term risk could be not only financial. It could be the fact that we don't have the right set of data, for sure. We don't have the right vision of the technological changes. You see the scenario, the climate scenario to 2050, 2030 are still very difficult to manage. And it's if you think about an electricity company or utility company, it's quite difficult to think about what could be the business model of the company in 20 years. But just think for a motor company. what is the business model of a motor company in, say, even in 2030. In 2030, we don't know, because we don't know if the car will be electric car, hybrid, hydrogen, other one, who will own the car. Maybe Google will be the most important car company, or Alibaba, or Amazon. So there are a lot of uncertainties in that. So that's the thing. And sorry, I was too quick on the thing. And then the regulators try to put a lot of discussion on climate stress test. So, and recently ECB published a map of the physical risk. Physical risk could be the risk inflicted to the company, to the people, to the institution, to the economy, due to a couple of events like massive flooding, wildfire, other sort of natural event. And you see the red area, which is South Europe, is mostly wildfire, and the blue one, which is mid-center Europe, is the flooding risk. So you have a lot, and some other risk could be erosion of the soil, increasing level of the sea, things like that. So you have a lot of risk, and then it could damage the entity. And then you could have, according to this scenario, you could have a sharp deterioration of the part of your portfolio default, and so the risk quality of the portfolio could be really challenged by the physical damage. Well, that's just the slides to show physical, non-physical. Non-physical is often the transition risk. For example, the fact that maybe an oil company cannot use the oil reserve they have because it will be impossible or forbidden by regulation, or forbidden by the condition on which you access to the oil. For example, the Arctic oil is more or less now abandoned due to pressure to protect the biosphere, to protect this specific environment. But so you have a lot of risks which are non-physical, but if you put the two together, you could have a lot of risk on some of the economies, and they are not totally negligible. Obviously, they are very far away. So so climate is very important, and I would something I didn't mention is that the job creation, the job growth of the 10 years following the crisis was really in monitoring risk, in compliance, in system. Now the job growth is in ESG, in non-financial risk assessment. If you have any ESG interest, capacity, that's a job where for the time being, financial institutions are desperately searching specialists, because this is something very complex. In financial, you have standard, you have accounting rules. In ESG, you have 200 standards. Standard & Poor's has standards. US TCFD has standards. IFRS want to create standards. CFA Institute want to create standards. So there was a study on how many standards we are on ESG. It's ahead, beyond 200. So it means that any NGO with some initiatives, some capacity, want to have a standard. So there is not a common language in ESG. It will probably arrive, but it's still not arriving, and that's something which is very stressful for banks, because they will need to embed the climate stress, but we don't know exactly what sort of event, what sort of impact take into consideration. But back on the summary of the session. So the bank moved from IL, incurred loss, to EL, expected losses. That's very important. And then what you have to have in mind is that EL IFRS 19 in profit and loss is not exactly EL in Basel. they are cousins. They are the same family or same group of family, but not exactly the same. EL, like IL, is subjective. So, but information set is a little bit better. And this is a topic where the regulators work to make sure that stage 3 bucket, the non-performing, will be more comparable in the future. But you see, have also in mind the Taleb views that we have the risk we know, we have the risk part, we know the unknown, and there is still something which is the unknown. We should be modest with the risk. So now if we move to the quiz of that session, I should have there. So if I change the presentation, I should go to this one, which is this one, I believe. So should change automatically, I hope, the quiz. Yes. So here we have the quiz and we will start the pool. So question 1, and it's yes or no. Incurred loss, IL, are lower than expected losses, EL, on a full cycle. Well, it's difficult to think about what is really a cycle, but if we look backward, it's possible to think that. If we look forward, it's more difficult to define a cycle. But looking backward, okay, quite a split outcome. Okay, we'll stop here. So there's a majority for yes. It should not be the case, but in fact, if you look backward, yes, it's a little bit lower, which means that still the implementation of IFRS, which is 2004, and the FASB fair value, which was 1997 in the US, I believe, till we moved to fair values, the temptation was to have incurred loss a little bit lower than to have IL a little bit lower than EL. But in theory, it should be very close to be the same. So let's see. Okay, we cannot see now, but the some research were made on a pre-2004 period, but it's still an area of investigation. But in fact, it's a little bit lower, but it should not, because at the end of the day, you should take in consideration the same factor. But maybe EL move you to be a little bit more cautious. Then question 2. It's again yes or no. EL in the profit and loss is different from EL in the Basel framework. This one is an easy one. Okay, I start the poll. Yes, overwhelming majority say yes, and it's yes. It is different because in Basel framework, you have a part, at least because in Basel framework, you have a part of the portfolio which is assessed under the standard method. Then, if you look in details at the slide provided by one of the accounting firm, I guess it was EY or PwC, you have more details, more understanding of why you have some difference. Question 3, so which is not something helping our life, but that's okay. again, question 3, yes or no. EL provisioning, both the IFRS and the US, is based on macro scenario. Yes, yeah, there is a skeptical part, but still, you use macro scenario because you need to have a foreseeable future vision. So you have to project, even if the provision are made now. It's a now which is an estimation of the future state of the world. So there is a sense of foreseeable future as far as you can incorporate it today. So the only way to do that is to do a scenario. And with that scenario, and in most of the banks use 3 scenarios: the worst, the good, and the base scenario. And you play with that, and you obviously you cannot compare directly the scenario between themselves. Most of the bank published the assumption behind the scenario. If you take the UK disclosure, it's quite a great disclosure set of information, and you have a lot of the information in terms of GDP, unemployment, thing like that. Then question 4. Banks can add a buffer on provision as an add-on on EL if they expect a recession. Yeah, good. That's the majority is right, and yeah, it's yes. The it's not a direct inspiration of Taleb, but the way is to say if the management believe that the model result, even if you weight the probability and say, okay, I put 50% in my worst case, 10% in my best case, and 40% in my central case. Even doing that, I'm not that comfortable because they have a lot of uncertainties. I can add up 1 billion provision, but then you need to publish that and to inform investors, obviously to inform regulators. That's a pre-requirement. But then you have, if you are listed, you have to talk to the market and to say that. But it's a possibility, and it's something which is very close from what Taleb wise statement is directing us. So now question 5. Question 5 is a little bit something we didn't see really. On small size loan, are they assessed on portfolio basis? Yes, and not name by name. So if you answer yes, it's on portfolio basis. Okay, we'll stop here. Yes, because you see, it would be very difficult to take a consumer loan of, say, $150 and another one of $500, etc., and to do an assessment of the risk name by name. So you do that on a global basis on a portfolio, and you say, I have in this area, say for example, Los Angeles. I have in Los Angeles, and even Los Angeles is not a good thing. You have to put an area of Los Angeles and to say in this district of Los Angeles, I have a consumer loan, and this consumer loan is that amount, and I assess expected loss on that basis. Or maybe the geographic is not okay. You could have consumer loan made by branch, made by brokers, made by point of sale, because the loans are coming from Walmart or coming from internet, etc. So you have to find the right way to assess the risk, and you can group, because if not, it would be very, very difficult. Our next question is about something we saw this time, which is in US stress tests, the performance on the test contribute to the computation of the capital conservation buffer. You remember the capital conservation buffer is a 2.5 conservation buffer, which is required from the Basel regulation. So you have the minimum CET1 4.5, and then you have the capital conservation buffer 2.5, which is making a 7% requirement. And the question is, in the US, they take a more conservative view, saying that this capital conservation buffer could be higher than the 2.5. Okay, so let's close the poll. Okay, then it's okay. Majority is right. What we say is that this capital conservation could be above 2.5. So the takeaway of that is that you can distort from the Basel rules if you take something more conservative. So if you say that you take a less conservative, it's not possible. If you take a more conservative, which is the case here, you can do your own rules. Obviously, US Bank complains and say it's not fair because we compete with other international banks, but US regulator believe that it's the best way to do that. They try to influence the FSB, the Financial Stability Board, in order to say, please follow our example. But for the time being, it's very difficult because it's a US stress test, and you cannot deploy a US stress test in every country, in China, in Japan, in Europe. So it would be very difficult to do that. But if you do to be more conservative, it's possible. Question 7 now is, again, yes or no. Central bank are introducing climate tests. Okay, we close the poll. Yes, the answer is yes. Be careful, because the verb is are introducing in the process too, is not have. If it was have, they have not, but they will introduce. And the big question is, should we penalize banks which provide funds to bad clients? If you have in your portfolio too many coal mining company, too many company with thermal coal operations, that's bad for the climate. So maybe that's something you should be penalized. So there is a discussion about putting assets between green asset and brown assets. And in Europe, the European Bank will be obliged next year to produce a green asset ratio, a GAR, and this green asset ratio will measure the percentage of the assets they finance, they invest in, which is green. So it's a beginning of installing a capital charge for the one with a bad outcome, bad result. Obviously, you have two phases of the regulation. One part of the regulation could say, we want to give you incentives so we can reduce the capital which is required because you are doing good, you are helping the economy to move on the right direction. And if the other way is to say, no, we will penalize the one with brown assets, we will ask you to have a surcharge. For the time being, it's the additional capital way which is which has the lead, but it's not yet decided. But you see a lot of international banks which are big in corporate and investment bank have already started now for 2-3 years to rank their clients, to monitor their big clients. And for example, I know that a bank like Crédit Agricole CIB, which Crédit Agricole is a big French bank, they have started to have a score, an ESG score, and mostly focusing on transition. You do not want to penalize an oil company because it's an oil company. That would be stupid. However, you want this oil company to move on the right direction and to move to energy supplying and to move to renewable source. So if the oil companies stay and say, no, I just want to be an oil company and make no change, obviously you warn them and you say, okay, at the end of the day, we will stop our financing because part of the financing is project directed and part of the financing is generally non-affected. But you can manage the two. I was recently reading that Goldman Sachs in the US had a score on around 7,000 clients internationally with an assessment of the ESG transition risk, and they will stop to fund the company if they do not behave correctly. The chairman of Deutsche Bank, Christian Sewing, say in a famous presentation this summer, I believe, yeah, it was this summer, that the bank will lose their banking license if they do not act correctly for the climate, and it will not be possible. And you have a lot of NGO putting a lot of pressure on banks. Obviously, it is linked to the history, to the experience. When you look at the picture on who are the bank financing coal, Chinese bank is the answer. Of course, Chinese economy is based on coal. And if you are a Chinese bank, it would be very difficult not to be on the coal business. If you are a Canadian bank, you are obviously financing sand tar because there are a lot of resources on that. Okay, it's bad, but coal is bad, sand tar is bad for the planet, but then it will take time. So it's very important to have this stress scenario, to have a transition movement. And as I was saying you before, it's an era where you have a lot of search for capacity, for intelligence, for capacity. The last question of the quiz is about the risk, and it's about a yes or no about the costliest event for banks was the Madoff fraud. Okay, very split. It's difficult to be sure that it was the most costly single event on all history, but on recent history, as a single event, it's the biggest fraud. It cost the gross cost was 50 billion. So 50 billion for one case, it's a lot. The Archegos we mentioned before was 10 billion, which is still a very, very important event. Then you have costs which are systemic, like the bankruptcy of Argentina, the bankruptcy of Mexico in the 90s. But they are not a single event with a single name. And Madoff, at the end of the day, the net is 20 something. and it's split between bank and non-bank, but it's still a very big one. So you're right to say yes and no. It's quite okay to say that. But the size of the fraud was very exceptional. I remember I was sitting on a trading room at a desk of a broker at that time when they announced that there was a loss. And the only thing I was knowing was that Madoff used to be a former Nasdaq, the U.S. stock exchange market, used to be a Nasdaq chairman. Okay, but then when the amount of the fraud came out, we were reading. It was written on the Reuters screen, 50 billion, but we were all the traders, the people around reading 50 million, because we cannot imagine at that time a 50 billion loss. It was too big. So I can't even remember my reaction and the reaction of the people around me. But then it was 50 billion, not 50 million. So, okay, thank you for participating to that. We will come back now to the session. It should come soon. So we will venture a little bit on the session 5. Session 5 is more general issue about the banking models. Banking models, due to the crisis, are very much challenged. And part of you remember the Brian Lowell breaking up the bank. The idea of the banking model today is to say maybe banks could be only a utility doing part of the job, and the rest of the job could be done by newcomers. The name of the newcomers is obviously fintech, but it could be also big tech. And the fact that you have a lot of discussion about what could be the future state of banking industry in, say, 5 year, 10 year, is reflecting the fact that the banking model are really challenged. We will, so you have a couple of reports about banking models saying you can make a distinction between retail, wholesale, and trading, and they have not the same characteristic. But then most of the characteristics look at the balance sheet, what we have done at the very beginning of this lecture, and you can have a category, and with that category you can have a P&L associated, and for regulators it's quite okay to do that way. For investor, it's much less the case. And if you look at the banking model, what is really making a difference is where are you in terms of clientele? Are you taking all the market or just a segment? Are you doing all the product or some of the product? Are you manufacturing the product or just making the distribution? Bank is supposed to be an era where there is no license, no invention in a sense, or if you have an invention, immediately it's spread out. The former chairman of the Fed, Paul Volcker, we mentioned on the trading, was famous because he said there is no invention in the banks on all my life except the ATM, the cash distributor. So then maybe the older invention was a plastic card, but he was very reluctant to believe that innovation were part of banks. So what happened in banks is that production, because of the spreading of the innovation, tends to be with lower margin, lower part of the margin, longer term. And distribution is normally the place where you have the value added. So if you are doing the production, maybe you can make scale. You can make margin because in fact you reach a certain size. Whereas distribution is not always linked to the size. Then the fourth question could be, do you have branch presence? Do you have point of sales? Do you have just internet? And then obviously geography is very important. And then it means that you need also to complete this point with the liquidity and funding sources. If you have a lot of market funding, that could be a big issue. And if on your deposits you have a low quality depositor moving very quickly, in UK, for example, we estimate that 20% of the client just move because you move your rates by 10 bips. So if you move the rates by 10 bips, you will have 20% of the market looking at your price. Maybe they will move or not, but they are very much looking at, and they can decide it to change. And with Today Bank online, it's very easy to do that. So in France, the same percentage would be between 5 and 10%. I don't know in Vietnam what would be the behavior of the people, but you have a part of the market which is very, very volatile. And that is very important in the funding, and obviously the capital. So I wanted to share with you a couple of examples of the pre-crisis models and their weaknesses. And I will try to upload a file to share with you. Okay, seems to work despite my bad connection today. So be careful because it's an Excel one. So I will try to reduce. Can you reduce that? So it's an. I don't know. It's very visible. Well, no, we cannot be really like that. Let me check. No, it's not very nice. No, I will do something else. I will send it to you on the so it will be. Sorry for that. We will stop here, and I will make the presentation slightly differently. I will send these models to you, and that would be on the document, on the library of Canvas, on the platform. And so you will have the document in front of you, not that one, because it would be too difficult to comment. So I will upload that on the list of the documents we share, and we will start with that tomorrow morning, because it's impossible to really work with the picture here. I was overestimating the capacity of the system to put an Excel file on. Okay, so I wish you a good evening, a good end of the evening, and expect to see you tomorrow afternoon. So it would be at 2 p.m. If I'm not wrong. Please try and correct me if I'm wrong. But if I'm not wrong, I expect you at 2 p.m. And the quiz, I will give you the quiz also. I believe I put them on the Canvas, but I will make sure that it is in. Okay. And sorry for the misfit on the recording. Have a good evening. Bye bye. And the answer for the quiz, obviously.